We're joined by the manager of Britain's best-performing long-short fund last year, David Crawford from Octopus Investments. Now, thanks for joining us. What was your view when you saw these numbers coming out of HSBC, and how do they sit with what you were looking for?
Okay, I mean, I had a small position in the stock which actually sold a week or so ago, which didn't look too great because the stock then rallied pretty strongly. But obviously, this morning numbers have disappointed, and the stock's come off quite a bit, actually below the level where I sort of sold it. So, sort of a good result in the end. I think the numbers are probably okay, a bit light, but it's the partly the stock has been so strong, and also there's been lots of brokers saying you've got to buy HSBC ahead of the numbers, it's going to be great, blowout numbers, and of course then when people get the numbers and think...
So just be set up to fall, really?
A little bit. I mean, if they had been blowout, I mean, the stock had already been, was already moving, so it was a bit of a, it wasn't a great trade as it turned out.
But it is still regarded as the go-to bank, the safe one amongst all of these banking stocks in the UK.
It is, it's the quality one. The issue is the valuation. It's on sort of 1.9 book falling. People are paying up against the book value because of the Asian operations, and that's why people are paying up for sort of the quality. But I suppose that leaves a little bit more vulnerable as well. You can buy, obviously, the British banks on put of 0.7, 0.8 times book. HSBC is more than twice as expensive, so you're paying a lot for that premium. And of course, you have to be a believer in the Asian growth to want to pay that book value.
Well, are you?
I'm a bit cautious on a lot of things at the moment, but I'm kind of more cautious on Asia at the moment.
Well, you've changed. I mean, last time you were on, you were actually a bit more bullish than this, but you seem to have become more negative. Why?
I think that a lot of the problems we had going back a few years ago are still there. It's just they've been sort of moved towards the government, the government's balance sheet, and so that's where now we're starting to see some problems there with things like Greece, sort of the Greece spreads widening out. So I think some of the issues that were there, where we've been papering over the cracks, are now coming out. And I just think with the China and the Asian story that China can't grow in the same way it used to grow without the exports, the sort of export-led growth that it had. So you can't be as positive as you are, but the market seems to be just as positive on Asia and China now as it was 3 years ago before we had the credit crunch. Right.
Let's just, overall, though, if you look at the your banking portfolio, how does it sit next to some of the other stocks out there?
I mean, I think the way to play the banks, I actually think the British banks, which are kind of more bombed out, RBS and Lloyds, could actually be a better way to play it than paying sort of the premium for the sort of the quality end. And my portfolio at the moment is structured sort of short, in terms of cyclical sectors, I'm kind of short the miners and long the financials. So I've got obviously some short beta on there and long beta on the financials. But if anything, I'm sort of more minded to be kind of negative overall on the markets at the moment.
So, I mean, what is that based on? Is it just that we saw such good gains last year that they're looking a bit toppy now, these valuations, or is it because of the economic situation in the background?
Yeah, it's a combination. I think the macroeconomic picture, isn't great because they haven't really solved a lot of the problems. It's just been sort of shifted around, and I think valuations are now actually pretty stretched. Certainly the markets aren't cheap on headline numbers. You've got a lot of assumptions built into the next few years to want to be a believer in the markets. You've got to believe that the recovery is going to come through the next 2 or 3 years for you to see much performance in the market.
Yeah, what about this notion of perhaps us entering into recession once again? Because things in Europe are not nearly as rosy as they seemed at the end of 2009.
Yeah, I mean, I do think we could slip back into recession. I think it'll just be different economies at different points. Europe seems to be the first one that's sliding back. I think the UK will be there pretty much. The US looks a bit more robust. But again, I do think towards the end of this year or next year, we could be back into recession territory. And I think China could slow down as well. And the market does look ahead. Sometimes it looks very short term, but sometimes it looks ahead, which it normally does. I think the market starts to look out to next year. I think we could see some further, further slides in the market.
David, great to see you as ever. David Crawford there from Octopus Investments.